You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, our end of the year tax planning for 2012. And on today's show, the individual response to the fiscal cliff with special guest Ken Davis, CLU, CHFC, CFP, and CPA.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I am your host, Steve Savant, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me on day 3, Ken Davis, CLU, CHFC, CFP, and CPA. Welcome, Ken.
Hello, Stephen.
I just always like to say that, and I think I'm the only guy in the United States that actually can say it without ever screwing it up. So, you know, we're talking about the fiscal cliff, and I saw the other night, people that do crazy things like jump off skyscrapers in parachutes, hang gliding. I mean, really bungee jumping off bridges. And I was looking at this and I was trying to compare the fiscal cliff to how could I get a soft landing if everything goes to hell in a handbasket, okay? Now, I noticed that the gliders, that's pretty cool. I mean, that's pretty nice way to get down, but you're always actually kind of at the mercy of the currents of the wind. And the winds right now are controlled by the political. That's why we have so much of a storm, because there's two fronts that are colliding all the time. The second one is a parachute. Now I like parachutes, but I've never done it before. I don't know about you, but I have never parachuted before. And I've noticed that every person that parachutes, as soon as they get close to the ground, they have to hit the ground running. That's where that phrase, hit the ground running, came from. And the third one, the one that I think is the safest, is to be in a hot air balloon, right? This is my fantasy. And let all the hot air from the politicians out of my balloon slowly, so I descend slow and I make it in a soft landing. Now, what we're going to talk about in this segment is how you can go to your customers, your consumers, your clients, prospects, with a couple weeks to go with some cool ideas that can mitigate the hard crash landing if we go down that road. Ken, let's talk about it right away. Let's get into it.
Okay.
Let's define some of the things that we can do now. One of the things that Ken loves to do is, should I defer deductions or take deductions? Should I do that now or should I take them later?
Well, if we're going to anticipate the fiscal cliff or the changes, if you've got a high net worth client that's making a lot of income, and now we have to parse that into wages, ordinary income, net investment income, passive income, all this type of stuff, putting the deductions off to next year might make sense. Normally, this time of the year, we're saying accelerate your deductions, defer the taxes into the future year. However, if tax rates really go up, especially cap gains, take a look at your portfolio, and maybe you want to capture that 15% cap gain rate instead of 20%. Maybe you want to avoid that 3.8% Obamacare tax, that Medicare tax that's going into place, that's going on all passive income. So you're going to have to start thinking differently than we used to in the past. And quite frankly, I would really encourage people to utilize their CPAs and other tax practitioners to help them say, if I do this, what is the impact on me under the current law and the future law, and what are my best options, and can I pull the trigger before year end if I do see the tax law change?
Do you think there's any advantage? There used to be, we're talking about deferring things. How about state taxes? Should I pay them on this side of the year, or should I let them go to the next year?
Well, you do have one of the main things is, if you want to reduce this year's income taxes, is you anticipate the fact that you have to pay your state income taxes and pay it before the end of the year. You make an estimate, pay it to the state government, and get a tax deduction on the federal income tax return. Well, maybe you want that next year. Maybe you want this year's deduction next year, and then at the end of next year, you're doing 2013's state taxes so that you have both in the same year. Again, it depends upon what's happening with the tax laws, what kind of tax bracket you're in, whether you're one of these people that are going to be hit by this 3.8%, and there's not a large percentage, quite frankly, that will be hit by that, but there are some, and those people should be thinking about it. And of course, there's other things like taxation, Social Security income, Medicare premiums, all kinds of stuff. It's not a simple thing just to play around with your brain anymore. You actually have to have tax software and do what ifs, all these different changes.
Well, I'm wondering, we are talking about the end of the year. We're talking about holiday bonuses are coming. I'm wondering if I should take my bonus on this side of the year, or I should defer it to the next year if my employer doesn't need the deduction, right?
Exactly. You may say, depending upon your state of being and situation you're in, say, hey, I want it this year with the tax rates are lower, or gee, next year is fine because I'm not one of those people being hit by some of this, I'm not one of the 2%.
What about real estate taxes, Ken? We talk about that at the end of the year. What do you think?
Well, let me defer that real quickly. You bring up a big issue, and that is people that are having their homes foreclosed upon or short sales or whatever. When that debt is forgiven, quote unquote, by the banks, normally in the past that's been taxable. That's like you received proceeds and paid the loan off.
Because it's a forgiven loan.
It's forgiveness of indebtedness is the concept. Well, there's special rules in place till the end of this year that say, no, you're okay. We won't tax you on the forgiveness of indebtedness because the government understands what a mess we've been in with our whole real estate situation. That goes away unless they extend it.
So let's just make sure we're all on the same page here. So if I'm going to my client who has had to turn his home in, unfortunately, because of the terrible economy, he will not have to take on an income tax hit like it would have been normally, but they extended some benevolency. Wow, that's a great thing for the government to do.
Well, and the rules are very complex there. If they use the money for something other than to pay off the prior mortgage or to improve the home and invested it or bought a new boat or whatever, it may not be forgiven. So these rules are not simple, and they really need to talk to a tax advisor about how all that works and see if it is something they should be concerned about.
Yeah, and as we're closing out this segment, I'm always thinking about, should I accelerate my income on this side of the year rather than next year? I always think, should I delay it? Should I take it? Again, one of the things Ken's always talking about is we have to crunch the numbers. There's tremendous software out there right now for not only individuals, but of course CPAs have the Monty load of all these calculations. And that software will help you determine, should I accelerate income? Should I pay taxes? Should I do my real estate? What side of the year should I do all this on? Right now is the time to do the math and crunch the numbers. When we come back from the break, we're going to continue our discussions on what individuals can do to respond to the fiscal cliff. And don't forget to enroll in IULUniversity.com for the best training, education, sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
Living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's giveaway at thebiz@brokersalliance.com. What are we giving away? The 2012 end of the year tax planning guide. And let me tell you, it's really a deep thing, but it's got really great what I call macro categories for Steve, because he doesn't want to read this report all the way through from cover to cover. And remember, a lot of things we're talking about are so tax centered this whole week's of shows. Always, always, always consult your tax advisor before moving forward with anything you hear. And if you're FINRA licensed, always check in with your broker-dealer compliance department before you start repeating anything we're talking about, because we don't give tax advice, we're just talking about taxes. We're not giving recommendations. We're continuing our discussion on the fiscal cliff and what can an individual do to respond to it. Now, Ken, you're going to hit, this is a bad boy issue for me. I hate, and I mean I hate, the alternative minimum tax with a passion. It was built for people back in the day, very wealthy Americans, very affluent Americans, to target them because they had such good CPAs. I think there's a little bit of accountability here by the CPA community, because
they did too good a job.
They did such a good job that the government came in and said, we have all these people making serious money and nobody's paying any tax. So they said, well, you're going to have to, from now on going forward, pay the alternative minimum tax. Okay, and I get that. But what I don't get is, how did that trickle down over the last 15 to 20 years? And now the AMT, alternative minimum tax, is sitting on the backs of middle class taxpayers. And on top of that, the administration says they're pro-middle class. The House says they're pro-middle class, and I don't see it. I don't see it.
Well, and I agree. And just so that people know, I'm not either picking on the conservatives or the liberals. It was
Well, wait a minute. I'm picking on both.
well. That's what I'm saying.
Yeah.
I'm picking on both too.
Right.
And basically, this concept of thresholds of exemptions. The alternative minimum tax was intended to go after the wealthier people that were doing massive amounts of planning. And that was a different era than we have today. And so they said, well, gosh, you have to pay at least a minimum, guys. I mean, come on.
I get that.
We'll give you some deductions. But what's happened is the way they did it is they have thresholds that they'll take your income and then they'll give you an extra cushion. And that's an exemption. It says, okay, your regular income plus this exemption, then if you're over that threshold, then we're going to hit you, okay? Well, what happened is that threshold became more and more meaningless over the years. As inflation creeps in, 1.5%, 3%, whatever it is, year by year, over time, that gets to be a much larger number. So what happens is this numbers benefit, the exemption gets smaller and smaller and smaller. It creeps in. And anything that isn't inflation adjusted will be impacted by that. And this alternative minimum tax, again, because they didn't want to show it on their projected budgets, it's like, okay, every year we know we're going to change it, but we don't want to show it in future budgets because it makes us look bad, okay? So we're just going to come in each year. We all know, we wink at each other and we're going to change this, and then we're not really going to hit the middle class. Well, here we are at the very end of the year, and they still haven't changed the exemptions for this year. And with the stalemate going on in Congress, who knows, maybe we will go over that fiscal cliff and we will be paying alternative minimum tax, and then you'll hear a hue and cry from the middle class America.
I promise you, the middle class is going to wake up not only on the passive income we talked about yesterday, but on the AMT, on inflation. All these things are compounding. It's going to be tough to live in America if we don't do something soon. By the way, here's another planning issue that you can do, and I love this one. We're trying to manage. I'm thinking of like at the end of the year, I'm trying to harvest my stock gains and my stock losses. But then I'm looking at something like, how do I play with my deductions, my exemptions? Oh, and the one you put on my list, which I really love, tax credits.
Well, there's not that many tax credits, but when you can get a tax credit, they're a dollar for dollar reduction in tax. We've talked about this in prior shows. A deduction, if I've got a $1,000 deduction and I'm in a 25% tax bracket, that's a $250 tax savings. But if I have a $1,000 tax credit, that's a true reduction of $1,000 of taxes. So there's the difference between a deduction and a credit.
Well, I was thinking in our state, we're allowed to give to certain schools and so forth. And if we're going to owe the state anyways, you can actually get a credit. You're just, instead of giving to the state, you're giving to the school of your choice, especially if your kids or maybe your family teaches or works there. I think that's
and that
a pretty
brings
good
up
deal.
a point that, there's a number of different kinds of tax relief for people with kids in college and stuff. And quite frankly, the rules kind of make my head spin. There's several different choices, so I'm not going to get into that. We don't have time. But some of those are going away this year, and so if you're concerned about educational types of tax relief, you really need to take a hard look at that or get with your CPA and go
And
through
keep in mind, we're talking that we just crossed over the IOU student loan debt of $1 trillion. Keep that in your back of your head too while we're doing all this about education. Another thing we're talking about, and I cannot believe for the life of me this debate's even on the table, we're talking about charitable giving before the end of the year, and we're going to be doing that all next week with Ken, talking about charitable giving. But talk about it a little bit here. We still got time to do this.
Yeah, you want to get your charitable donations to your church or synagogue or your favorite charity, for animals or whoever.
As long as it's
veterans,
IRS approved.
Yeah, get it in, get it done now. And here's the thing, don't wait till December 31st because the IRS gets so greedy about taxing us. It's like, oh, you write a check? Well, you could cancel that check after the beginning of the year, so no, you don't get a deduction. So make sure that you get it done early enough so that the check can clear and that you meet all these very detailed rules.
Are you telling me that the service is micromanaging my December 31 checks to my nonprofit approved IRS charity?
That's right.
And they could come back and say, you could have canceled
Yeah,
it?
because they're concerned about people playing games, and to be honest, there are people who will do that. They'll take the deduction, show the check, and then cancel it in the next year and say, oops.
The American taxpayer gaming the system? Oh
Yeah,
my
they
God.
got
Oh my
people
God.
like me trying to help them out, but I wouldn't do anything like that.
It's all
so.
about the tactical use of CPAs and accountants. Oh yeah. Well, listen, you can watch all our shows by clicking on the red on-demand video button right on our homepage at brokersalliance.com. That's the Buzz on the Biz for today. Get in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.